In today's video, I'm going to be showing you guys how to invest $500 in this volatile market right now. Now, what I'm going to show you today doesn't just require you investing $500. This can also apply to people that want to invest $100 all the way up to $10,000. However, I am just using this $500 as an example. But in today's video, we are going to go through where to invest, how much to invest, what strategy to invest, and then what to invest in. So this video is going to be really detailed, so you guys are going to love it if you're a beginner especially, but even if you are intermediate or advanced, a lot of the things that I am going to say in here you might enjoy and learning as well. What is up guys, Stephen Harvey here from the Plan to Profit channel, and before we dive into things, I'd like to ask you guys kindly, if you haven't subscribed already, then hit that subscribe button below, because roughly about 80% of you guys aren't actually subscribed to the channel, but you still watch my videos. And of course, if you do like this video, then hit the like button down below. That's greatly appreciated. But that's all from me. Let's get started. Now, before you start investing your money, I do recommend investing it in other places. The first one is actually setting up an emergency fund. So if you don't have an emergency fund, I highly recommend creating one of those. Usually between 3 to 6 months, livable expenses should be within that fund. And then if you have any high interest debt, I highly recommend paying that down before getting started with investing. Now, step number one is setting up what we like to call a retirement account. So in New Zealand here, we have what we call KiwiSaver, and that's an account that you can use to either purchase your first home or all the way up to a retirement. So if you haven't set one up yet and you're from New Zealand, I highly recommend it, even if it means that you just contribute the minimum amount. It's definitely worth your future. However, if you are in America, you can set up a 401k, a Roth IRA, or an HSA account. Then we can move on to choosing a brokerage account. So in this video, I will be using examples of Sharesies and Hatch Invest. So these are platforms that New Zealanders can have access to if they want to invest in the New Zealand Stock Exchange with Sharesies, or in the US Stock Exchange for Hatch Invest. Now, I do have links to these platforms down below that you can use to sign up, and you guys will get a bonus. So with the Sharesies, you will get a $5 bonus, and then for the Hatch Invest, you will get a $20 bonus as well. So that is step number one. Now that you've decided where you want to invest your money, what platform you want to use in brokerage, we move on to step number two, and that is how much you want to invest. Now, my advice here is only invest what you're comfortable losing, especially in these economic times of uncertainty. So that was quick in step number two, but step number three now is the investment strategy, and this is where we're going to really get into the details. Now in this video, I am going to describe two strategies. The first one is a lump sum method, and then the second one is what we call dollar cost averaging. So the lump sum method basically means that you're going to be investing everything all at once. So a study performed by Vanguard has shown that this type of method, lump sum method, has actually outperformed the dollar cost averaging method. But we're going to move on to that one and explain why I prefer the dollar cost averaging method. And so what dollar cost averaging means is you're gradually investing that money, or that $500, at different amounts. Or for example, $500, we're investing $100 at a time, and we can ease into the market. So an example of this is we could invest $500, $100 per week, and that's over a 5-week period. Or we could invest $500 every second week at $100 a week. So obviously $100, wait a fortnight, invest another $100. Another way we can dollar cost average is based on the percentage change or the dollar amount of an individual stock or ETF. For example, if I want to buy a stock like Ford, let's say it's averaging around about $5 per share, and I don't want to invest my $500 all at once. If I were to use the lump sum method and I did invest $500 all at once, that would actually get me 100 shares at $5 a share. But because the market is quite volatile right now, I would prefer to use the dollar cost averaging method and take that $500 and invest $100 at a time over a 5-week period. So if we quickly jump into my computer here, we can have a look at a little table that basically breaks down the dollar cost averaging method and we're going to use Ford for an example here. So here I have on the left hand side, we have $100 split into 5, so that's the total of $500, and then the price of each share, we're going to do it as if the price has been going down. So we can see $5, $4.50, $4, $3.50. So our first initial investment, let's say we invest $100 at $5 a share, we would get 20 shares out of that. We then see that the price drops either at a 10% decrease, or let's say if we're doing it by dollar amount, we want to invest another $100 when the price reaches $4.50. So we can see here if we invested $100 at $4.50 a share, we would then end up with 22 shares. The next week, we see that the price drops again down to $4, and we can get 25 shares out of our $100, and then it drops a further 50 cents down to $3.50, which leaves us with another 28 shares. And lastly, our last $100 out of the 500 we started with, the price is suddenly way down at $3 a share, and we invest $100, giving ourselves 33 shares. So how does this work out? So if we have a look here, the dollar cost averaging method, if we add all these numbers up on the right hand side here, we can see that we have actually ended up with 128 shares of Ford stock over that 5-week period. Compared to a lump sum method, we can see the lump sum method, as I said earlier, we would have only purchased 100 shares at $5 a share when we wanted to put it all in at once. So this is why I believe the dollar cost averaging method is the best method that you could be using in the market right now, especially how volatile it has been. So right now I'm going to head on to the Hatch Invest platform, and I'm going to show you guys how you can be using this dollar cost averaging method. Using this platform here, you can also do the same on Sharesies if you want to do it with New Zealand shares or ETFs. And of course, if you are using Robinhood or Webull, any other platforms in the United States that allow you to place limit orders, then this is a very similar method, or very much the same, basically the same. However, each platform let you do certain things. So what we're going to do is we're going to use the Ford example like I used earlier. So we're going to click on here and we're going to type in Ford. Now we head down here to click on buy, and that will take us through to the buy option. So we have a market buy order, we have limit buy order, and then we also have auto invest. What we're going to be using is we're going to be using the limit buy order. So we'll click on this, and then now we want to decide how many shares we would like to buy. So I'm going to use the example of the 20 shares like in the table. So if we type in 20, and then let's say we want to wait for the share price to drop down to $4.92. So including the $3 fee that Hatch Invest charges between 0 and 300 shares, because we're getting 20 shares here, the total price is going to cost us $101.40 US. So the numbers might not be exact as what I was showing in the graph before. That was literally just an example of how it works. But this is a way of doing it where we can click review limit order, and then we can actually decide how long we want that limit order to be in place, because it will have an expiry date on it. Now once that limit order has been placed, we can then make another limit order, and then this time we can say when the share price drops down to, let's use the $4.50 example, when it drops down to $4.50, I want to buy another 22 shares in that one. So that's going to cost about $102. So we're sticking around that $100 range, right? And then so on again, we'll say it drops down to $4, but this time we want to buy, let's say 24 or 25 shares. So again, that leaves us with $103 in total, and so on, so on. So you guys get what I mean here. So you want to place about 5 limit orders there, all at those separate share prices. And so what will happen is when the market is open, if the share price does drop down to each one of those levels, it's going to go ahead and use that money. It's really important to have the money in your wallet so that Hatch Invest can spend it. They'll use that money and they'll buy the shares that you would like at the share price you have specified. So moving on to step 4, now that you've decided which method you would like to use, either the lump sum method or the dollar cost averaging method, we're now going to decide what we want to invest in. And we have 2 choices right here. We either have individual companies like Apple, Amazon, or Tesla. So these are obviously individual stocks that you buy just from that company, or we have what we call mutual funds, which are based in ETFs, or in general, what we like to call index funds. So when you buy an index fund, you are buying a collective of companies all in the same basket. So for example, you can have a ETF or index fund that contains the likes of Amazon, Apple, Tesla, all within that same thing. So it invests tiny amounts into each of these companies. Index funds are a great way to diversify your portfolio and reduce the risk involved. If you actually jump on Google, you can actually find out why Warren Buffett himself actually prefers index funds and really recommends them to every type of investor. So earlier I did give you an example of buying an individual company or individual stock. Now I'm going to show you a few ETFs that you can decide from, because there's so many ETFs and index funds out there. It can be a little bit overwhelming to begin with. So I'll give you a few examples and then you can decide what you want to invest in. So back into my computer now, we can see we have the Vanguard ETF. So all you got to do is just type in Google Vanguard ETF list and it will just list all of their ETFs. So Vanguard have 74 ETFs and they're all split up into 5 different categories, okay? So we have the US bonds ETFs, we have US stock ETFs, we then have international bond ETFs, and then we've got international stock ETFs, and then lastly here we have sector and specialty ETFs. However, popular US stocks and ETFs from Vanguard here are the VUG, the VTI, and the VOO. So I will let you guys do this yourselves and you can have a look at what's in them. But really quickly now, I will show you the VUG just so you can have a look what's actually in them. So once we've clicked into the ETF we want to get a little bit more information into, we can see here in the VUG ETF, which is a US stock ETF, we can see these are the top 10 largest holdings. So we have the Microsoft, Amazon, Apple, Alphabet, Facebook, and so on. And so these are the top 10. So it invests 43.9% total net assets all in here. Now these ETFs are also available on Hatch Invest, so you can use that platform if you want to buy into these ETFs. However, if you do head over to Sharesies now, we can actually have a look at the US 500 and you'll find out that the US 500 actually invests in the Vanguard S&P 500, okay? If you don't want to use Hatch Invest and you prefer using Sharesies, then you can also purchase that index fund through Sharesies. More examples on Sharesies though, these are ones that I own as well. We have the NZ Top 50, so that's the top 50 companies in New Zealand. And then as well as we have the US Large Growth Fund. All of these actually above here are just ETFs, so you can find out, you can click on them and see what they contain. So that is basically all from this video. I'm just going to give you a quick recap because I know this can be a bit of an information overload with everything I said. So step 1 is where to invest, what kind of accounts we want. So do we want the KiwiSaver, the Roth IRA, or then we want to decide the brokerage. So do we want to go with Hatch Invest, Sharesies, Robinhood, or Webull? Then we want to decide how much we want to invest. And remember, like I said, only invest what you're comfortable losing, okay? And of course, make sure you have yourself an emergency fund and you have all that high interest debt paid off. Step number 3 was choose your strategy. So that's deciding whether you want to go with the lump sum method or with dollar cost averaging. And then at step number 4, we went over what we want to invest in. So do we want to invest in individual companies like Amazon, Apple, and Tesla, or would we rather go with ETFs and the index funds such as the Vanguard S&P 500 or the US 500 on Sharesies? And lastly, don't be intimidated if none of this made sense to you the first time round. You can always watch this video again. But one of the biggest barriers with investing is intimidation, because at the end of the day, you hear people throwing around words that you haven't even heard about and you think it's very technical, but really it's all about just doing. And trust me, I was in the same position at the very start as well. It's just a learn and go process. And I warmly invite you guys to use the comments down below to ask me any questions that you have, or you can also head over to my Instagram, which I'm going to show on the screen here, and you can send me a direct message on there and I will be sure to answer your questions. Because at the end of the day, you guys are supporting me by liking, subscribing, and commenting on this channel, so there's no reason why I can't support you guys as well. However, that is all from me today. I have left those links down below for some of the material in here and for you guys to use for your sign up bonuses to any of those investing platforms. But like I said earlier, don't forget to like the video if you enjoyed it, leave any questions in the comments below, and don't forget to subscribe. We'll see you in the next one.